because now the price needed to first tap into this demand before going all the way to the upside. And if you took your trade here, it was going to be a loss for you, even if you knew that the market was supposed to go to the upside. So that is the power. Okay, now let me show you how you can utilize the information that I'm giving you to make your trading even more professional. With that being said, I'm going to show you how you can use market structure to find your points of interest. Remember now, knowing where the market is going to react is knowing where you should place your trades. So what is a point of interest? A point of interest is an area in your chart where the market is most likely to react from. That could be your demand, that could be your supply. So with that being said, we're not going to waste any time. We're just going to jump straight into, you can see that this market was in a downtrend and then successfully shifted into an uptrend. So we had a lower low, a lower high, a lower low, a lower high, a lower low, and then came a higher high, meaning this is where the trend shifted because we broke from lower highs into higher highs. And every time this happens, what you need to do is to wait for the market to go back into the demand that was responsible for the shift of the whole trend. So what am I saying? Every time the market does a trend shift, when it shifts from bearish to bullish, it's gonna break that last lower high, create a new higher high, then move back to the demand that was responsible for the creation of that leg that broke structure and came with a trend shift. So this demand down here becomes your point of interest because this is an area where the market is most likely to react from. So with that being said, after the last lower high is broken, the market is going to create a new higher high and a new higher low. On this higher low is where you look to enter. On this new higher low is where you look to enter because this higher low is going to be reacting on a demand. It's going to be reacting on a demand. This is where you can look to enter your first trade. But if you miss your first trade, this is where you can look to enter your second trade. Because now it is most likely to retrace here and then to drop all the way back into this demand that got created here. It usually drops for demand on the first leg of movement. On the second leg of movement, it usually goes for this whole order block that was created here. So without wasting any time, let me just get to it. You can see the formation of what I showed you here. You can see the formation of what I showed you here. You can see. So without wasting any time, let's get to it. We had a low, we had a high, we had a lower low, we had a lower high, we had a lower low, we had a lower high, we had a lower low, and we had a higher high. Because from here to here is the same leg of movement. One would have said maybe this was already a higher low. It's not a higher low because I did tell you that whatever happens inside our range is considered to be sub-market structure. So this was our range as the market failed to break this high around here. So that was not a break of structure, but rather a liquidity sweep because the market failed to close above but closed inside the range. So the break of structure only came from here, only came from that candle. So this low and this high was the same range. So whatever happened inside that range was considered to be sub-market structure. So let's remark again. We had a low, we had a high, we had a lower low, we had a lower high, a lower low, a lower high, a lower low, and a higher high, meaning that the trend has successfully shifted. And what did I say? I said you wait for the price to break the last lower high. Wait for the price to break the last lower high and create a new higher high. This is a new higher high that was created. After you see this, what do? You wait for the price to push back to the demand that was responsible for the break of the last lower high. You heard what I said? You wait for the price to break the last lower high and create a new higher high. After it creates a new higher high, it's gonna go back to the demand that was all responsible for the break of the last lower high. And on that demand is where you look to take your entry because that demand becomes an area of high interest or a point of high interest. Simple. You see, the market pushed back into this demand and then gave us a beautiful push to the upside. And should you have flopped after you saw that the market broke this structure and then it retraced around this area, should you have flopped and taken your trade around here, you were gonna get stopped out so bad. because now the price needed to first tap into this demand before going all the way to the upside. And if you took your trade here, it was going to be a loss for you, even if you knew that the market was supposed to go to the upside. So that is the power of understanding how the market moves before you start saying things that don't exist, like saying this was a stop hand. There is nothing like a stop hand. The market is always right. It's just you who doesn't know how the market moves. So there is nothing like a stop hand. You, knowing this information that I'm giving you right now, would have understood that you need to first wait for the market to push back to this demand. After pushing back to this demand, that's where you were going to take your entry and move with the market all the way to the upside. And should you have missed taking an entry around this area of high interest or around your demand, and don't worry about me saying demand, you already know how demand works, but I'm still going to give you some refined information on it, as I'm doing right now with the market structure and finding your areas of high interest. So if you miss taking your trade here, you wait for the market to break this higher high that came after the break of this last lower high. You wait for the secondary break before taking your trade. If you missed your first entry right here, you wait for the secondary break, because the first break occurred when we broke this last lower high. So you wait for the market to break this newly formed higher high, and then you wait for the market to break it. After breaking this last higher high, then the market pushes back to around this area. It then rejects and continues to push to the upside. So that's how you take your second entry if you missed your first entry. And even if you did take your first entry, this can help you to swing your trades in the proper way, because if this is your first entry, you know that the market is supposed to continue buying. So after breaking this higher high, you anticipate the price to push back to this order block that gets created around here. You anticipate the price to push back to the order block that gets created, and then you stack up your entries. You add your second entries here, this being your first entry and this being your second entry. And this is how you leverage, where you can turn a small account into a big account. So it's that simple. It's that simple. I don't know if you're seeing this, but this was our last lower low, and this was our last lower high, and came a higher high. This was our last lower low. This was our last lower high, and came a higher high. And then the price pushes back to this demand, and then the price pushes back to this demand. Buys breaking this higher high, buys breaking this higher high, and pushes back to this cluster of order blocks, and pushes back to this cluster of order blocks, and then boom, and then boom. Simple as that. So yeah, man.
Can we pretend that it ends in the night sky? I like shooting stars. I can relay was a